The topic of our documentary is Bitcoin, blockchain and its disruptive nature. On this slide you can see the content of our documentary. This is a quote from Mark Andreessen. For 5 years, many of the world's best mathematicians and computer scientists have been studying Bitcoin and trying to figure out what's wrong with it. They haven't found anything yet. So, what is Bitcoin? Bitcoin is the best-known cryptocurrency, which was introduced to the world in early 2009. Today Bitcoin is regarded as decentralized, peer-to-peer, open-source network that allows the proof and transfer of ownership without the need for a trusted third party. All Bitcoin transactions are recorded in the blockchain, a massive and transparent ledger of each and every Bitcoin transaction maintained. The integrity and the chronological order of the blockchain are enforced with cryptography. There is no central authority that oversees Bitcoin. The unit of the network is Bitcoin with a little b or BTC, which many consider a currency or internet cash. With a maximum of 21 million Bitcoins available, the mining of Bitcoins follows standard supply and demand economics. The final Bitcoin is expected to be created around the year 2140. So, how does Bitcoin work? User can transfer Bitcoins over the network like anything that can be done with conventional currencies, including buy and sell goods, send money to people or organizations, or extend credit. It is not possible to buy Bitcoins at a bank or general foreign exchange. However, it is possible to purchase, sell, and exchange Bitcoin for other currencies at specialized currency exchanges, which facilitate conversion of Bitcoins into fiat currencies or other cryptocurrencies and vice versa. Also, some people choose to mine for them. The Bitcoin wallet is a mechanism for storing the public and private keys. These digital wallets are available as software, mobile and web wallets. According to statistics from Blockchain Info website, today there are 9.5 million registered wallets, and 110 Bitcoin exchanges in the world. The Bitcoin network is based on a mathematical proof involving a search for a sequence of data known as a block. This block produces a specific pattern when a Bitcoin hash algorithm is applied to the data. A hash is the name given to a single attempt at solving the block sequence. The blockchain is the core underlying technology of Bitcoin digital system that records and verifies transactions in a tamper and revision-proof way that is public to all. Blockchain technology builds an agreement between all parties involved in a transaction, and every transaction would be chained to each other so one could never duplicate or change the ownership of Bitcoin. People around the world called miners use computer hardware to do mathematical calculations for the Bitcoin network to confirm transactions and increase security. Mining is a specialized and competitive market where the rewards are divided up according to how much calculation is done. As a reward for their services, Bitcoin miners can collect transaction fees for the transactions they confirm, along with newly created Bitcoins. The formula and software are freely available for anyone to use. As more Bitcoins are created, the mathematical computations required to create more Bitcoins become increasingly difficult. When Bitcoin mining first started, it was possible to successfully mine coins on a standard home computer. However, as the difficulty in finding blocks increased, ever more powerful computers are now required to successfully mine Bitcoins. Today the market for Bitcoin mining has moved to more enterprise-grade data centers, where the leading 5 miners are generating 78% of the revenue.
During our London trip, we managed to find a Bitcoin ATM machine. So basically now we will show you how it works. Basically what you need is an e-wallet and this machine, so buy Bitcoin. So we have this e-wallet We just scan it. Take the money. Oh, and we bought the bitcoins. So basically it's very easy to buy bitcoins today and pay for your goods and services in coffees, restaurants and in the internet.
Now, let's look at what opportunities and benefits Bitcoin offers to companies and the public. Firstly, Bitcoin is an open network. This means that anyone can go back to blockchain website and trace the movement of Bitcoin from its initial release. This leads to increased auditability of transactions for companies and the public. Also, mining process of verifying transactions protects from Bitcoins being double spent or counterfeited. Secondly, unlike banks, Bitcoin is open for anyone, anywhere in the world and anytime. This is especially a great opportunity for underbanked people. According to World Bank, there were 2 billion underbanked people in the world in 2015 and only 41% of people in emerging countries had a formal bank account due to the limitations imposed by banks such as minimum salaries. So with Bitcoins, these underbanked people can still have access to payment and remittance systems without having to go to banks. Thirdly, Bitcoin network is decentralized, peer-to-peer. The following is the cite by the inventor of Bitcoin, Satoshi Nakamoto. The root problem with conventional currency is all the trust that's required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust. Banks must be trusted to hold our money, but they lend it out in waves of credit bubbles with barely a fraction in reserves. We have to trust banks our privacy, trust them not to let identity thieves drain our accounts. We have to agree with these statements given the histories of sudden devaluations of fiat currencies by the governments, repeating financial crisis and significant number of cases of credit card details being hacked. Thus, Bitcoin diminishes the role of a middleman and therefore leads to a more transparent, faster and cheaper transactions. And the most importantly, Bitcoin was specifically designed for fast transactions at low costs. For example, as illustrated in this table, the current retail merchant payment systems such as Visa, MasterCard and American Express take around 2.5 to 3.5% transaction fees for credit card payments, while Bitcoin takes maximum of 1% only for faster payments. Otherwise, there are no fees. Also, the low transaction fees allow merchants to accept micropayments, in other words, no minimum transaction levels as with debit, credit cards. As noted by Satoshi Nakamoto, banks' massive overhead costs made micropayments impossible. Therefore, there are currently more than 100,000 merchants all over the world accepting Bitcoins, including Microsoft, Expedia, Dell, Tesla and many others. Furthermore, in terms of remittances, as highlighted on this table, currently, the systems such as Western Union and MoneyGram take around 8 to 10% transaction fees and it takes around 2-3 days in order for the money to reach its destination, while Bitcoin takes only a maximum of 1% and the money transfer is processed instantly with confirmation in 10 minutes, thus decreasing the counterparty risk significantly. Bitcoin is extremely beneficial for cross-border transfers, especially given the increased number of money transfers from developed countries to emerging countries. Therefore, as you can observe from the graph showing average daily transactions volume by payment systems, Bitcoin transactions volume is growing and has already beaten Western Union and almost reached PayPal. Again, Bitcoin is specifically designed for fast transactions at low costs. Goldman Sachs have looked at the dollar volume of transactions in retail, e-commerce and remittances and have estimated the potential savings from using bitcoins by applying prevailing and bitcoin fees to dollar volumes of transactions and have come to an estimated savings of around $210 billion US. For example, the potential savings only from retail is estimated to be around $155 billion US given the significant volumes of retail transactions all over the world. Apart from significant savings in fees and processing times, Bitcoin transactions can only be effected by the user who has the private key, putting the user in full control of the Bitcoins. This offers protection from unwanted charges by unethical merchants once those got the credit card details. Also, no substantial personal information shared compared to credit card payments, which is at risk of leakage or theft. However, it is worth noting that Bitcoin wallets and exchanges are vulnerable to risk of theft, and therefore Bitcoin users should be security conscious. And probably the most significant opportunity offered by Bitcoin is the platform for future innovation. According to a survey performed by Magister Advisors at the end of 2015, large financial institutions have already identified 10 to 20 or more potential blockchain applications and planning to invest over $1 billion on blockchain over the next 24 months. For example, Visa, who has been investigating blockchain's potential for 18 months, is now taking its first step towards disrupting the market for interbank payments by testing a system for sending money between banks over blockchain. Santander is creating a blockchain lab to work on 2025 projects. Further, Barclays and UBS have been one of the first big banks to join R3 Consortium, which is a consortium of more than 70 of the world's biggest financial institutions in research and development of blockchain usage in the financial system. Both Barclays and UBS are also opening blockchain labs in London for experiments of using blockchain for issuing bonds and settling trades. Citibank is building 3 blockchains and creating its own cryptocurrency. Goldman Sachs is seeking crypto trade settlement patent. So, in summary, what happens in the Bitcoin network is that data in the form of Bitcoin transactions are broadcasted and verified before being kept on the blockchain. Bitcoin technology may therefore be adapted for transfer of other types of data such as stocks and debt. This slide describes bubble behavior of Bitcoin. Bitcoin began 2013 trading at about $13 and rose to more than $1,100 by late November, which caused growing interest from big investors, venture capital firms, and ordinary citizens. The volatility that Bitcoin has demonstrated, through its bubble behavior and reactions to global economic shocks, would suggest that it is unsuitable as an investment tool. It was revealed that the main Bitcoin exchange, Mt.Gox, was fighting off a series of attacks from hackers. This caused a significant drop in the value of Bitcoins, with the exchange claiming that the hackers manipulated Bitcoin values. A string of bad news out of Mt.Gox and other exchanges sent prices fall sharply. As you can see, Mt.Gox's decision to shut down its trading activities on the 25th of February 2014 led to the burst of the bubble. Despite this, the currency has recovered from its price crashes, with traders placing enough confidence in it to invest their own money. A recent problem in Bitcoin is theft. Bitcoins are encrypted, but it does not mean that Bitcoins cannot be confiscated or stolen. And actually the price collapsed several times. This table illustrates a report of more than 40 known theft cases. Mt.Gox collapse is the biggest theft, which accounts for $470 million or 91% of identified thefts. In all cases, $517.9 million is confiscated or stolen since 2010. Interestingly, stolen bitcoins are traded on black markets. Major black market is a Silk Road, which accounts nearly for 70% of illegal bitcoins. Illegal activities impact wide range of people by destabilizing situation on financial markets. The programming code is free for anyone to view, and programmers worldwide are free to contribute to the code or copy the code to launch their own alternative cryptocurrencies, altcoins. This feature gave incredible raise in wide range of altcoins. Most altcoins are direct copies of Bitcoin's C++ source code, where programmers make minor modifications to the coin's parameters such as total coin supply or confirmation time. This table illustrates latest market capitalization of cryptocurrencies according to coinmarketcap.com. As it is demonstrated, there is 709 cryptocurrencies and the number of altcoins is increasing each day. Bitcoin has a highest market capitalization accounting £9.5 billion, but altcoins reached 16% from market's total. On this slide we would like to highlight main impacts related to increase of altcoins. Wide range of altcoins gave opportunity to invest in altcoins with modified parameters. Security of altcoin exchanges should be carefully checked, due to hacking of main cryptocurrency, Bitcoin. Regulation of different types of cryptocurrencies could be hard for government of countries around the world. On next slides we demonstrate legal issues of cryptocurrencies. The official currency is transacted within legal framework. Cryptocurrency lacks regulatory framework and public oversight. Therefore, cryptocurrency poses serious legal threat pertaining to liquidity, fraud, and solvency. The transactions are carried out on the internet, which itself poses risk of security, hacking, and viruses. Cryptocurrency is a currency and has the properties of an asset. Therefore, cryptocurrency transactions are subject to tax like any other asset or currency. Cryptocurrency transaction may attract capital gain tax, income tax, transaction tax, and wealth tax. In March 2014, the Internal Revenue Service in the United States ruled that Bitcoin will be treated as property for tax purposes as opposed to currency. This means Bitcoin will be subject to capital gains tax. Her Majesty's Treasury launched a call for information in 2014 on the benefits and risks associated with digital currencies. Her Majesty's Treasury notes risk of illicit activity in digital currency networks. In April 2016, updated action plan for anti-money laundering and counter-terrorist finance was issued. Her Majesty's Treasury intend to bring digital currency exchange firms into anti-money laundering regulation, as it is at the point where users cash in and cash out of digital currency networks that money laundering and terrorist finance risk is highest. This is consistent with a risk-based approach. On the 3rd of June 2015, the New York State Department of Financial Services, NIDFS, released a long-awaited regulatory framework for digital currency companies. The final release of the BitLicense follows nearly 2 years of fact-finding and debate. The NIDFS began crafting the rules after it determined the technology should not be regulated under existing state law. The transaction cryptocurrency is based on trust on peers, promoters, and the system. In case of any breach, the victim may not be able to produce acceptable legal evidences for recovery of the damages. In January 2014, federal prosecutors of U.S. charged the CEO of BitInstant, a major Bitcoin exchange company, with laundering digital currency through Silk Road, an online drug marketplace. The cryptocurrency is governed by non-government entities, anonymous promoters in the form of trust, society, hybrid form, or through any unknown status. The jurisdiction within which such entity operates and the form of the organization is not publicly known. The framework of organization is highly decentralized, working on the internet through peers. The court may not be able to consider such entity as juristic, and people behind the organization may not be traceable. In case of any dispute, establishing accountability will be virtually difficult. So, why the Bitcoin is so important? Even though the Bitcoin has many drawbacks such as bubble behavior and price volatility, legal and regulatory issues, it has the potential to threaten financial services institutions since it can make money transfers cheaper with far lower cross-border fees. Moreover, Bitcoin has a number of important advantages because of its open, decentralized and peer-to-peer network. Bitcoin's underlying technology blockchain has created many opportunities for the future innovations. Nowadays, financial institutions and companies are more focused on application of its underlying blockchain technology, which can be used for a wide variety of transactions, smart contracts, authentications, micropayments, and so forth. There are many possible applications of blockchain technology outside Bitcoin network. For example, the blockchain in international payment system promises a new set of tools to cut costs and challenge the profit pool of the middlemen and centralized institutions. Also, blockchain can replace the collateral manager in the repurchase agreement contracts with distributed ledger, thereby removing the bottleneck and simplifying the transaction. Another example is that blockchain technology can help to track, retain and monitor ownership of debt distribution, reduce loan administration costs and improve the accuracy of transactions. Moreover, it can significantly improve insurance processing by ensuring process compliance, reduction of fraud, and improving streamline of document management. Thereby, blockchain is changing the way information moves in a very fundamental way by offering new capabilities for firms to interact with each other. In our point of view, Bitcoin and blockchain are innovations that could change our everyday lives. Bitcoin offers huge opportunities to the companies and the public and at the same time has challenges to address due to its infancy. Uniform regulation at least concerning anti-money laundering will help Bitcoin to be more broadly adopted. Once it becomes more mature and more firms, people and countries start accepting it, the role of Bitcoin exchanges, which are currently susceptible to a risk of theft, should decrease. With fast development and increased number of users, Bitcoin seems to become popular and useful payment system with low transaction fees and fast processing times. Currently, its true value is mainly associated with underlying technology, blockchain, which is clearly disrupting the financial markets. The biggest financial institutions in the world have already recognized the value of this innovation and investing heavily on it in order to be able to improve its current systems and compete in terms of fees and processing times in the long run, which will have positive impact on the public. Blockchain has a huge investment potential within the firms as well, allowing more efficient workflow for all parties by making process-level improvements.